Hello everyone, welcome to this enlightening journey where we unlock secrets to early retirement through real estate. We're here to explore a fascinating topic that can potentially transform your golden years into a time of relaxation and financial freedom. We're talking about early retirement and how you can achieve it by leveraging the power of real estate. In this video, we'll delve into 5 intriguing strategies that can help you retire early. We'll talk about rental properties, real estate investment trusts, house flipping, real estate crowdfunding, and real estate syndication. Each of these methods has its unique benefits and can be a game changer for your retirement plans. We promise to keep it simple, relatable, and engaging. So, even if you're a beginner, you'll find our discussion easy to follow and understand. So, without further ado, let's dive into these 5 exciting strategies to retire early with real estate. First on our list is the popular method of rental properties. Now, when we talk about rental properties, we're referring to the practice of buying real estate, whether it's a single-family home, a duplex, or a full apartment complex, and then renting it out to tenants in exchange for monthly payments. It's a strategy that's as old as land ownership itself, and it's been making savvy investors money for centuries. So how does it work? Well, the idea is simple. You purchase a property, you find a tenant, and then you collect rent. The rent you receive should, in an ideal world, cover your mortgage payments, property taxes, insurance, and maintenance costs, with a little left over for profit. But it's not just about the immediate income. Over time, as you pay down your mortgage, you build equity in the property. You're essentially getting someone else to pay for your investment, and in the end, you own a valuable asset outright. Let's consider an example. Imagine you purchase a duplex for $300,000. You find 2 tenants, each willing to pay $1,500 a month in rent. That's $3,000 a month in income, or $36,000 a year. Now let's say your mortgage, taxes, insurance, and maintenance costs come out to about $24,000 a year. That leaves you with a tidy profit of $12,000 annually, not to mention the equity you're building in the property. So, what are the benefits? Well, rental properties offer a steady cash flow, potential appreciation in property value, and a cushion against economic downturns. Plus, as a landlord, you have a certain amount of control over your investment, which can be appealing to many. But it's not all sunshine and rainbows. Rental properties require a significant upfront investment, potential for tenant issues, and the responsibility of property management. However, with careful planning and due diligence, these challenges can be managed effectively. So, rental properties present a promising route to early retirement. Now let's move to our second strategy. Next up is another fantastic strategy: real estate investment trusts, commonly known as REITs. Imagine a vehicle that allows you to invest in real estate without needing to buy a physical property. Sounds convenient, right? That's precisely what REITs offer. Here's a simplified explanation of what REITs are. Picture a company that owns, operates, or finances income-generating real estate. This company allows investors to buy shares, similar to how you would buy stocks of a corporation. Each share represents a proportional fraction of the real estate assets owned by the REIT. The functioning of REITs is quite fascinating. They pool the money of several investors to purchase a portfolio of properties, which can range from office buildings and shopping centers to apartments and hotels. This allows for diversification, as your investment isn't tied to a single property but spread across multiple assets. One of the significant advantages of REITs is that they're required by law to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This makes them a great source of regular income for investors. To put this into perspective, let's consider an example. Suppose you've invested in a REIT that owns a portfolio of shopping malls. When these malls generate income, whether through rent or sale of properties, a portion of this profit is passed on to you, the investor, in the form of dividends. REITs also offer the benefit of liquidity, as they're traded on major stock exchanges. This means you can buy and sell shares of a REIT just like you would with stocks, providing the flexibility to adjust your investments as needed. In conclusion, REITs present a unique and accessible way to invest in real estate. They provide the potential for regular income, diversification, and liquidity, without the hands-on management typically associated with owning a property. With REITs, you can have the best of both worlds: the stability of stocks and the tangible benefits of real estate. Now, let's explore the third strategy: Coming up next is a strategy that requires a bit more hands-on approach: house flipping. Dive into the world of house flipping, where the smell of fresh paint is as intoxicating as the potential returns. House flipping is essentially a three-step dance. First, you purchase a property that's seen better days, often at a discount. Second, you renovate or improve it. And finally, you sell it for a profit. Simple on paper, but like any dance, it requires rhythm and timing. Let's consider John and Jane Doe, a couple who decided to flip houses in their small town. They purchased a rundown two-bedroom house for $100,000. Over the next 6 months, they invested another $50,000 into renovations. They were able to sell the property for $200,000, walking away with a profit of $50,000. Not a bad payday for half a year's work, right? But remember, house flipping isn't always a guaranteed success. It's a strategy that comes with its fair share of risks. Unexpected renovation costs can creep up, housing markets can take a downturn, and properties can sit unsold for longer than anticipated. Our friends, the Does, for example, might have been stuck with a property they couldn't sell if the local housing market suddenly dipped. To mitigate these risks, it's crucial to have a keen eye for properties with potential, a good understanding of the local real estate market, and a solid budget for renovations. And let's not forget the most important ingredient: patience. House flipping can indeed be a lucrative venture, but it's not for the faint-hearted. It requires an entrepreneurial spirit, a knack for seeing potential where others see ruin, and the tenacity to handle the unexpected. In essence, house flipping is like a treasure hunt, where the treasure is a diamond in the rough waiting to be polished and turned into a gem. It's not just about making a profit, it's about bringing value to a neighborhood and turning houses into homes. House flipping can be a lucrative venture if done right. Let's move on to the fourth strategy. Our fourth strategy is a modern twist to real estate investing: real estate crowdfunding. Now, if you're wondering what that is, it's a method of investing where multiple individuals pool their resources to fund real estate projects. Think of it like a potluck dinner, but instead of bringing dishes, everyone brings a chunk of money to invest in a property. This strategy is particularly interesting because it allows you to invest in large-scale projects that you might not be able to afford on your own. Plus, you can do it all from the comfort of your living room, thanks to the internet. But like all investments, it comes with its share of pros and cons. On the bright side, it's a great way to diversify your portfolio and potentially earn attractive returns. It can also give you the chance to invest in high-quality real estate projects that were once only available to institutional investors. On the downside, though, it's not without risks. Real estate crowdfunding platforms may fail, and the projects themselves can underperform or even face foreclosure. It's also less liquid than some other investment types, meaning you can't quickly sell your shares if you need cash. Let's say, for instance, you choose to invest in a residential development project in a growing city. You contribute a set amount, along with hundreds of other investors, and if the project is successful, you share in the profits proportionally. Real estate crowdfunding democratizes the investing process, making it accessible to everyone. Now, let's uncover our final strategy. Last but not least, we have real estate syndication. Now, you might be wondering, what is real estate syndication? Think of it as a team sport where several investors come together to buy properties that are more expensive than they could afford individually. It's a joint venture where each player brings something unique to the table, be it capital, industry experience, or even a knack for spotting lucrative deals. Here's how it works. A lead investor, or syndicator, pools resources from multiple investors to acquire properties. The syndicator typically handles the day-to-day management of the property, while the investors provide the necessary capital. Profits from the investment are then shared among the group, relative to their initial contribution. Imagine this: you're part of a syndicate that purchases a high-rise apartment building in a bustling city. As an investor, you don't deal with tenant issues, maintenance, or even property taxes. The syndicator manages all that. Your job: sit back, relax, and watch your investment grow. The benefits of real estate syndication are manifold. It offers access to high-value properties, diversification of your investment portfolio, and potential for significant returns. Moreover, the risk is divided among the investors, making it a safer bet than going solo. So, if you're looking to retire early and want to invest in real estate without the hassle of managing the properties yourself, real estate syndication could be your golden ticket. With real estate syndication, you can leverage the power of collective investment to achieve your retirement goals. And there you have it, 5 effective strategies to retire early with real estate. Let's quickly recap. Rental properties, a classic method that provides a steady income, real estate investment trusts or REITs that allow you to invest without the need for hands-on management, house flipping, a strategy that requires a bit more hands-on work but can offer substantial returns, real estate crowdfunding, a modern approach to real estate investment, and finally, real estate syndication, a strategy for those looking to invest in larger projects. These strategies offer diverse options to suit different investment styles and risk appetites. It's about finding what works best for you and taking the first step. Remember, the key to successful retirement planning is starting early and diversifying your portfolio. So, start exploring these strategies today. Thanks for watching, and don't forget to subscribe for more practical tips on early retirement.